So second home here, we're going to be talking about a vacation home. So what I think will be important for people to understand when they're looking at a second home in the mortgage space is that there's three classifications of uh, occupancy. So when we talk about a second home, we're talking about a home that they'd use on the weekends, a home that they would go to for the summer. It's people shouldn't confuse it with an investment property. So an investment property is going to be something where they're going to purchase the home, put a long-term renter in it. That would be considered an investment property on a mortgage application. So you've got your primary residence, which is where you sleep every night. It's where you go to work. An underwriter is going to be looking to confirm that the commute's reasonable to work. We have a lot of people working remotely these days, so those lines are a little bit blurred. But ultimately, when we're talking about second home, it's the vacation home. So you've got primary residence, second home, and investment property. So why would a second home be a valuable asset? Well, I would think that obviously there's the lifestyle factor of it. So if someone has a place that they like to go to regularly and they don't want to be renting, like, for example, a ski house, right? Sure. So that's something that we know a lot of people in our area is pretty common, like maybe a ski house in Maine or Vermont and or even northern New Hampshire. And in that case, the value is going to be the lifestyle for the family, a place to go, a place to have their own space, not to be renting and coordinating rentals or hotels when they're in that area. So if someone loves an area, they're committed to an area for a long term, the second home would be a valuable asset because it's going to allow them to grab some appreciation in an appreciating market. They're not going to be burning money on rent or hotels. They're going to have a space they can call their own. They can improve it. They can fit it out the way they like it. So yeah, I think it's mostly for lifestyle and long-term planning that someone would look at, a second home. The appreciation is going to, if you're looking back over the last couple of years, the appreciation in the second home areas, whether it's summer house on the Cape, something in the Lakes region, something here around the seacoast of New Hampshire, or any of the ski areas have seen huge appreciation. So I think it's just a great thing for people to do if they're committed to that area.
Yeah, I think I'll add too, Raj, you started to allude to it, that you're seeing more on TV these days about Airbnb and people trying to get into this. Oh, I can have a second home, but I can also maybe rent it, and so like Roger said, have that lifestyle, go away on that ski trip, go to the beach for a couple weeks in the summer, but then also take advantage of weekly rentals, right? It's a more common practice these days. The problem, and what you want to consult, I think, a mortgage professional on is the lending guidelines don't really account for how that works right now. So you have to be careful. If you're going into this purchase with the intention of really probably renting it more than using it as a second home, that's something we want to just, you have to keep that in mind. But otherwise, if true intention is second home lifestyle, you want to use it as a second home majority of the time, then I think it's a great opportunity to expand your portfolio, a little bit more real estate under your investment portfolio, in conjunction with the more traditional investments like your retirement.
And so when you think about qualifying for a second home, the way that we would approach it when we make first contact with the client is we're going to look at their debt to income ratio. We're going to look at down payment. So typically on a second home, which a second home, they always want to consider that you can't buy a multi.
That's right.
As a second home.
Yeah, single family or one unit only. Yeah.
Right, because some people will think, well, maybe I'll get multifamily and I'll keep one unit for myself. So it's really important that once you go 2 to 4 unit, it's got to go investment property classification for mortgage underwriting, and that's going to increase the rate a little bit. Like, the great thing about a second home is that it's the same rate as the primary residence. Right. So, and what that means, like, to a consumer is like, okay, you're talking about like the standard, prime, good rate of that day would be applicable to a primary residence and second home. Whereas in an investment property, you're talking about larger down payment requirement for qualifying and you're going to be adding about 0.75% to 1%, and maybe even a discount point or two, depending on obviously a lot of factors. But in general, if someone's just thinking about it off the cuff, and we're just having a quick coffee together, and they say, "What's the difference in rate?" I'd say you want to plan on it being at about 1% for your math, and then obviously there's a lot of factors that go into pricing out a loan, but primary and second home are the best rates, and those are the rates you can primarily see advertised by lenders and talked about on the radio and in advertising. No one's really going to be advertising an investment property rate because it's going to look higher because it is. So when qualifying for a second home, we're going to be talking about obviously assuming that someone has a good credit score. So anything really over 620, 640 is going to give them access to conventional, where conventional is going to be the only place to finance a second home. There's other programs like FHA, USDA, VA. None of those are going to allow.
Yeah, that's correct. Those are primary
second
residence.
homes.
Yeah.
So, and then down payment 10%, right?
Yeah.
So down payment 10%, which I think is great with a good credit score. Anything really over 700, the PMI, everyone thinks that the PMI is so punitive, but when you actually run the numbers versus having some PMI and keeping that other, rather than putting 20% down to get rid of PMI, putting that 10% down to enable you to keep that money in your 401k or in your investment account or nest egg that you're growing for your family, and having a small PMI, especially with good credit. A lot of times when we talk with financial planners about it, they're going to be able to, even in, very moderate risk, safe investments, return more almost than the cost of that PMI, and enables people to act on their second home earlier in their life, which, owning real estate is typically a long game. So if you can buy in earlier rather than waiting to pull together that, like say the property's 300,000, and it might take you another year to save another 10%, which would be 330,000. It enables them to act a year earlier, and that's if it's in a good appreciation year, it might even correct itself by the end of that year anyway. So I feel like that's really important for people to know. Back to 10% down. So we're talking qualification here. 10% down would have PMI. It's a pretty simple, I always call it like a fifth grade math equation, right? When we're running debt to income ratio, it's very, very simple. We're going to take, the denominator is going to be the person's income. And there's a lot of factors to figure out income. There's like, your basic W-2 salaried person, but you can also get into self-employed. You can get into if someone has annuity income, asset depletion if they're over age 59 and a half, which actually in second homes might come into play a little bit more if people are later in their lives purchasing their second home. But in the denominator is going to be the equation to figure out what their income is, and the numerator is going to be the primary residence that they have, the principal, interest, taxes, insurance on it, any car loans, car leases, student loans, and minimum payments on credit card debts. And this is something that when we're talking with someone, we can figure it out in a matter of, a 10-minute phone call. We can figure out the debt to income ratio. Say, yeah, this looks like it's going to work. So let's go a little deeper. Let's do a credit pull. Let's confirm all the numbers and then give them some options. And typically when they're looking at the second home and they compare it to, well, we go up every year, we're going to spend, a ski house in Vermont is going to be $6,000 to $9,000 a winter, and so comparing that to, purchasing, it could be a lot more valuable. And the debt to income ratio is similar to what we're looking for in primary residence. So in most of the loan qualification work, the lenders or the guidelines, which typically will refer to what, in this situation, we're talking about conventional guidelines, Fannie Mae and Freddie Mac are going to be looking at, 45-ish% debt to income ratio with a little variation depending on down payment and credit score. And so if someone is living where I'm paying all my bills every month and I'm putting money away. And I feel like, if I run my numbers and I add the, potential principal, interest, taxes, insurance, and PMI in this second home, and I still have money after my my post-tax income, if I still have money to put away after that, then most likely they're going to be under a 45 DTI. So I think those are things that come to mind for me for qualification. Anything you'd want to add to that, JC?
No, I think maybe just a couple things. I'll talk about. I'd like to just have people understand when they're comparing, trying to buy this as a second home versus an investment property, and kind of skating that line, because we'll get the question. I want to buy it as a second home, but I'd also like to use potential rental income to sort of offset or help with the qualification. And when you're buying a second home, again, like I was mentioning earlier, can't use the rental income. We don't want you to be renting that property. It's for the intention of using as a second home. So you can't use income to help offset your debt there. If you want to buy it as an investment property and you're going to rent it, then sure, we've got opportunity to use that rental income. So that is something to think about as you're thinking, as a client is thinking about, what does my debt to income ratio look like? Rental income is not part of that equation when it's a true second home. If it's an investment property, it can be part of that equation. And just to touch on the debt to income real quick, usually what I try to give people a quick visual. Roger was talking about, that ratio, right? And so I try to tell people just real simple numbers. Let's say 2 people in the household, they're both borrowers on the loan, and they each make $60,000 a year. That's $120,000 a year in annual income. We break that down on a monthly basis. That's $10,000 a month in income, right? So that's before taxes. That's what we base our debt to income ratio on. And then let's just say their mortgage payment, their car payments, student loan payments, other debts like that we'll be reporting on credit, and the new second home payment. All of those combined are, $6,000, let's just say. Well, or excuse me, let's say it's $5,000. $5,000 of debt into the $10,000 in income, we're at a 50% debt ratio, right? So in a scenario like that, that debt ratio might be a little too high. We've got to figure out a way to, maybe we back down the purchase price, maybe they do put more money down, maybe they pay off a debt to qualify. So I try to give people that quick visual. 10,000 is just an easy round number to kind of do the math with. So when folks are thinking about that, it's a good place to just look at, okay, what does my income look like? And if you're not sure how to calculate it because you're commission based or you're hourly, your pay varies in some way, then that's when you really want to talk to us, and we'll help you figure that out.
Yeah, because it's not always intuitive too.
It's not,
like
yeah, right.
How you actually have to figure someone's commission income or their hourly. It's not. It's almost like 7 times out of 10 the number that we come up with after running the guidelines of how to compute it over the average of the last couple of years is a little different than what people actually think they make. So that is important. But we get through that in a matter of a couple minutes into the phone call. Always something that I touch on with vacation versus investment, if I didn't say it earlier, is always treat it on your application the way you're really going to use it. It's not worth saying you're going to use it as a second home and really using it as investment property. We'll get people who will ask about doing that. Our company stance is, however you're really going to use it is how you should apply. If we get the feeling that someone's misrepresenting, then we're going to dig deeper and really try to get to that scenario, because that's the lender's job in protecting the Fannie Mae Freddie Mac system, to make sure that people aren't misrepresenting things, and which would put the portfolio in a place that it really shouldn't be. With the risk being different than what they represented on the application. What is that? The process is pretty much the same for either one.
Yeah, same.
Qualifying, debt to income ratio, appraisal. Are we getting appraisal waivers? I think second home purchase is an appraisal waiver potential.
Yeah, we don't, you can still get them. It's just not something we see as often. We're starting to see them more now.
Yeah. Like the appraisal waiver is a pretty neat thing that comes into play. Like investment property must have an appraisal. Second home and primary residence, when we run it through the Fannie Mae Freddie Mac automated system, it's it's tracking some data inside that system, which will issue some appraisal relief, meaning that it accepts the value as stated in the data entry and not require a physical appraisal. That's eligible on primary and vacation homes where their system feels comfortable that the value is acceptable without further verification. So second home is eligible for it. I think we probably see it maybe 10% of the time on purchases for vacation homes if the down payment is a pretty good amount. So typically at 10, I don't think you can get it all under 20% down.
I think you need to be at an 80,
to be at least 80 LTV.
20% down, yeah.
But if someone has 20%, 30%, 40%, and the valuation of the home is in an area where there's enough data in their system, they might get an appraisal waiver. So that is a difference between vacation home and investment that's kind of neat. But other than that, everything's is pretty much the same. The investment property, in the debt ratio, there's a difference here, which is like talking about the potential rents, right? So if there's a lease, right, we're going to go by 75. Well, we're going to go by 75% of the lease, usually, as long as the appraisal is not lower.
Well, yes. Well, generally, what the underwriter is going to default to the rent schedule on the appraisal. If it's a purchase, even if there is a lease, they'll evaluate and they'll go case by case. If the lease itself if there's a big delta between what is actually on, if the lease seems like it's over market, for some reason or another, then they might default to the lower number on the appraisal. But if it's in line, we've seen them use either. So yeah, and then it's great because you're taking 75% of that lease. So again, if the lease is $1,000 a month, we're taking 75% of it and actually washing it or subtracting it away, taking it away from the debt itself, reducing the mortgage payment for the debt to income calculation, which helps a lot of borrowers qualify for investment properties.
And those are some things you'll need to know about second home mortgages.